Hey everyone, if you are navigating the kind of crazy complexities of localized corporate taxation in India, well, you're in exactly the right place. Welcome to this explainer. Today, we're diving straight into managing Indian corporate taxation and asset accounting, specifically within SAP S/4HANA. We're going to break down exactly how modern systems handle these highly specific, heavily regulated accounting requirements, literally without breaking a sweat.
To kick things off, let's address the elephant in the room, right? Why on earth do organizations track depreciation twice? I mean, it sounds like double the work, but this actually reveals the core tension in asset accounting. Organizations absolutely must maintain completely separate records for their financial statements and their income tax returns. It's just a dual-ledger reality that finance teams deal with every single day. And honestly, if you don't set up your system correctly to handle it, you are in for a massive reconciliation headache at year-end.
Okay, so here's our agenda for today. We've got Section 1, Book versus Tax Depreciation, Section 2, Indian Income Tax Rules, Section 3, Mastering Block Keys, Section 4, Managing Asset Transactions, and finally, Section 5, Essential Depreciation Reports.
Let's jump right into Section 1, Book versus Tax Depreciation.
So, book depreciation is what you're going to find in your company's general ledger. It directly impacts your financial statements and, of course, your overall trial balance. Tax depreciation, on the other hand, is the amount specified strictly for your company's income tax returns. Now, the total depreciation over the life of an asset, that's eventually going to even out to the exact same total. The major difference here is simply timing, because the timing of when an asset's price actually reflects as an expense differs between your ledger and your tax return. Maintaining dual parallel records is an absolute necessity. It's a must.
Moving on to Section 2, Indian Income Tax Rules.
Okay, so under Section 32 of the Income Tax Act, depreciation cannot be calculated on individual assets like standard accounting practices usually dictate. Instead, it must be computed on a block of assets. Basically, the law prescribes specific asset blocks and their corresponding rates. Your depreciation is calculated on the written down value, or WDV, of that entire block after posting all the relevant transactions for the year. And remember this part, the closing WDV of an asset block for the current year automatically becomes your opening WDV for the following year. To handle this in SAP S/4HANA, we use what's called the group asset functionality. Because asset acquisitions and retirements are managed at the block level for tax purposes, users often set up dedicated asset classes purely for these group assets. This lets the system manage specialized income tax depreciation areas, often configured as Depreciation Area 15 or 35, keeping your tax block calculations completely isolated from your standard Companies Act depreciation areas. Pretty neat, right?
All right, Section 3, Mastering Block Keys.
Now, it's fascinating how block keys elegantly link to their legally prescribed rates. A block key is, simply put, a specific group of assets sharing the exact same tax depreciation rate. The SAP localization natively understands that transactions, like acquisitions, retirements, and transfers, need to be treated differently in the IT Act depreciation calculation at this block level. It automatically manages your opening and closing written down values, completely shifting the burden of tracking away from you and right into the system.
So, the absolutely crucial point to remember for Indian localization is the 180-day rule. You might know it as the put-to-use rule. Basically, if an asset is put to use for 180 days or more during the fiscal year, typically on or before October 3rd, it gets the full prescribed depreciation rate. But if it's used for fewer than 180 days, the depreciation is strictly limited to 50% of the applicable rate. And the best part is, your SAP S/4HANA system is designed to automatically calculate this restriction based on the transaction dates you enter. No manual math required.
Let's move on to Section 4, Managing Asset Transactions.
If you're migrating to S/4HANA or running an implementation, you've got to keep the number 12 in mind. When you use the system's CSV upload apps to assign existing assets to their respective blocks, your asset number must be exactly a 12-digit value padded with leading zeros. This strict formatting is absolutely essential. It ensures seamless data migration when mapping thousands of individual assets into their new tax blocks. Now, while recent S/4HANA versions have shifted heavily toward intuitive, web-based Fiori apps for daily tasks, these underlying transaction codes remain the absolute backbone for specialized localization. You have AS01 and AS02 for basic creation and assignment, but the real power? That comes from the localized J1I series codes.
These are your go-to commands for updating opening values via Excel, assigning blocks, and managing any manual master data adjustments mandated by auditors.
And finally, Section 5, Essential Depreciation Reports and the Month-End Process.
The month-end process in S/4HANA relies on a very strict sequence of events. To ensure compliance and, actual accuracy, you should always follow this run order. First, run the app to update your asset transaction details for the period. Second, optionally run your projection reports to anticipate year-end tax impacts. And finally, execute the calculation report to review the projected depreciation and lock in your closing written-down value.
SAP actually provides these 4 essential Fiori apps, which form the absolute backbone of the asset block management workflow. Report I lets you drill down from the block level to see the individual assets. Report I aggregates everything. Report 3 is your calculator, and Report 4 is your forecasting tool.
Now, there is a critical dependency here. Report I2, the Update Asset Transaction Details app, must always be run before the calculation report. Why? Well, because this is the app that actually aggregates the individual asset acquisitions, retirements, and transfers and pushes those values up to the block level. If you skip this step, your calculation engine will literally be reading outdated, unaggregated data, and nobody wants that.
Once everything is updated, Report 3 acts as your central engine. This app reads your opening WDV, grabs the aggregated transactions from Report 2, checks for any manual auditor adjustments, and automatically calculates the final tax depreciation amount. At year-end closing, running this for the last period allows you to automatically update and carry forward the closing WDV to the next fiscal year. It's a real game changer.
Finally, we have Report 4, the Depreciation Projection Report. Think of this as your crystal ball. It allows you to enter projected acquisitions and retirements to simulate expected depreciation for the year. This offers massive value for proactive tax planning and year-end provisioning, long before the actual financial postings are even complete.
I'm going to leave you with this final, somewhat provocative thought. As tax regulations inevitably evolve, is your system's foundation robust enough to adapt automatically? Or will you be left manually reconciling those pesky timing differences? By fully leveraging S/4HANA's localization tools, from block keys to specialized group assets, you can transform a chaotic dual-ledger nightmare into a streamlined, automated corporate taxation process.